You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today I've got my friend Ben Emons. Ben is a managing director at Medley Global Advisors, one of the largest macro advisory companies, also a macro strategist. Ben, thank you so much for being on the podcast. It's wonderful to have you here.
Hey Sri, great to be here. Looking forward to the discussion.
Yep. Now it's awesome that you're wearing a New York t-shirt but have a San Francisco background. So
Yeah.
can't pick which side of the US you want to be in.
Yeah. Each side is great, but West Coast has its real charm and nice weather. But you get the bears and the earthquakes and the wildfires. You go back east, you get the floods, but you get a vibrant city like New York City. So I like both. I love both.
Absolutely. Yep. Ben, could you start by telling the audience a little bit about your background, how you got into finance and, how you ended up, where you are today?
Yeah, sure. So I've been in financial markets now, believe it or not, 26 years. And I started out in the mid-90s as a derivatives trader. And I'm from the Netherlands. You may sound the accent familiar. So I worked in Amsterdam in the first sort of 4 or 5 years of my career as a derivatives trading and swaps, options, bond options, and all those products that were at that time a huge boom. And in the 90s, then in the 2000s, I moved to London. I kind of continued that derivatives career, but more with prop trading, and I got involved through that prop trading into what I call strategy. Like they saw, hey, you have ability to write and speak with clients. And as I sort of did that in the early 2000s, I made my move over to the United States as I followed my wife, and I got in the States. And after some first steps, I ended up at First Nuveen Investments, like a large money management firm. Eventually ended up also at PIMCO, working with the famous Bill Gross and Mohammed Al-Arian, where I was really involved in global portfolio management. And then when things sort of like evolved, I went on. I first ran a fund for a registered investment advisor for a few years, like a modified fixed income fund with a lot of private credit. And I eventually moved forward with being a really full-time macro strategist, which I really enjoy doing. It's a lot of fun. It's really connecting a lot of information, speaking a lot with clients, obviously involved in publications, external communication media, and really enjoy the job. So I have a versatile career. I've been on the sell side, the buy side, the fiduciary side, now more on, say, the consulting, macro advisory side. And anyone who's listening to this podcast, encourage you to do similar. Your career should evolve, and if you're versatile in your skill set, you can do a lot of different things.
Yep, absolutely. I completely agree with that. And, Ben, let's start off by talking about, today is the 3rd of June, and, today is a Friday, first Friday of June. And so the non-farm payrolls report came out, the jobs number, as it's called. So, what are your thoughts, and, what was your take when you saw that number? And, obviously when you dig deeper into the data, what are the insights and the implications that, you're able to see?
So in a way, this report was really interesting and pivotal for several reasons. One, it's a pulse on the economy right now in terms of all the fear mongering about a recession. Was that warranted, yes or no? I think this report took that completely out. Like, if people were worried that we were in an imminent recession, then this report would have already shown up, seeing job losses across the board. It didn't have much of any job losses. If anything, there were pretty robust gains. It may have not been as broad-based as before. Some retail trade, there was a detraction there. But if you look at leisure, look at business services, you're looking at government, you look at healthcare, education, it's all improving. Most of all, I think there was the second part of it, the labor force participation continues to show revival. Important that now we're getting more and more women pulled into the labor force, willing to come back and work, which is important because that has been the concern with the pandemic that a lot of women were sidelined because of dealing with family and not able to work while we deal with COVID. So that's clearly changing. The amount of people actually that are what they classify as under the economic discouraged workers, but then for specific reasons, which is mostly COVID. Now that pool has shrunk now a lot. It's just, I think I was saying about 700,000, 800,000 people. That used to be more like 3-4 million people. So clearly that continues to show that the reopening of the economy is just bustling and it's just moving forward. There's nothing that stops that anymore. Not even the new variants that are out there now. It's just the economy is completely coming back to normal. And lastly, and this was important in the latest Fed communication that we received yesterday by Brainerd, today by Mester, they've started to outline what they're going to do with rates after July. You know, they're both in the camp of not pausing with tightening. That's one, but it also bases upon reports like this. This is the first report that they're going to make an assessment about the economy. There's going to be another 3 reports, payroll reports following up until September, same for inflation. And in each of these reports, they want to see, let's say, consistent moderation, call it that way, moderating, labor dynamics, moderating inflation, so that they feel that they can, after they've tightened with several steps of 50 basis points, they can maybe slow that down. That was the big debate last week. Now, this report also took that completely out. There is no moderation on the labor market. It's the growth rate itself may be slowing, but that's really, really high top line growth rate. We're talking here about a labor market that is resilient. So the unemployment rate has not much room to rise. If anything, it may actually start to decline again. So it's a report that Mester jumped on and said, like, if we continue on this track, we're going to have to hike in September too with 50 basis points. Matters, of course, to financial markets as we know now, because markets want to understand what policy is going to do. So I think this helped the markets yesterday with some more certainty. Today was a different story. But I think if I take the payroll as a summary, it was a good report. It was a report that doesn't show that we're in a recession, and it's a report that gives us more certainty about Fed policy from here.
Got it. And so, usually people point to, for example, so if you look at what the Fed manufacturing indices, so, the one from say Empire State, for example, so what they showed were one, producer expectations of prices paid in the future move lower. So that's one thing. The other thing was it also showed signs that supply chains might be easing. And the third thing is that a lot of people tend to imply that once the for the Federal Reserve to stop hiking, what we would have to see is sort of a shift around in the labor market. So for broadly speaking, how strong is the labor market? And two, do you agree with that idea that once the labor market starts to shift, unemployment goes up, job growth falls, stuff like that, we start to see the Fed cut?
Yeah, that is the working assumption. But we have to understand that we do deal with inflation dynamics that have dramatically changed, not just because of the pandemic, but also because of the shock from Ukraine, which is so significant that we're now dealing with more stickier, persistent food and energy price inflation that we haven't had before. And that makes the economy different in terms of what employment is going to do from here. So we're seeing little bit tentative layoffs in certain aspects of the economy. Fintech as one area. There's some in technology. We saw it now from Tesla today that he's looking to cut maybe up to 10% of his workforce. Whether it will actually happen, we'll see. But that's more, I think, an example of that the pandemic mushroomed those companies or those industries. They hired en masse a lot of people. And now that the pandemic is waning and changing and we're going back to normal, you're seeing somewhat layoffs appearing, which on the whole doesn't do anything to the unemployment rate in itself, because the labor market is so tight. There's still way more demand for labor than there is available people, even though there's slowly people coming back into the labor force. And so I think if you think about the previous era of, yes, if unemployment rate goes up, the Federal Reserve tends to react to that more forcefully by pivoting with its policy and go back to easing. That's really pushed out into the future, further out, because the Fed has to tackle inflation before it can actually really do something about rising unemployment. In fact, it's actually implicitly somewhat happy or encouraging that if unemployment rate were to go up somewhat, that would alleviate the pressure on inflation.
Right.
And the one concern that has come into markets thinking is that that may not be enough because of the real specific dynamics within inflation as it relates to food and energy. That's because of those physical markets in commodities and energy are so tight that price pressures are not easily to be alleviated there. And there is some element of wage price spiral that has been happening. And that too is another concern. So I think we're staying in a tight labor market that, although more people come into the labor force, it may not necessarily take the pressure off inflation that easily. And so it's going to take more time. So that means that once the Fed has risen rates, say up to 3%, 3.5%, it may have to leave that rate there for some time before it can cut rates, as the economy then would eventually really slow down to a recession.
Right. And at the beginning of your answer, you were talking about the supply shock that came about because of the Russia-Ukraine situation. And broadly speaking, the other problem is just a broad blockage of supply chains, which has been driving inflation. And so how useful are rate hikes when it comes to this? So when you have a supply issue, and especially one that's caused by a geopolitical shock, so you're seeing higher commodity prices. Russia, Belarus, Ukraine, they're a big producer of potash, and Russia is a big producer of ammonium nitrate, so fertilizers. So you're seeing a big supply shock from there. So how useful are these rate hikes, when it comes to a geopolitical event, considering that, these rate hikes, at least they do nothing for the actual problem at hand, which is the geopolitical and the supply shock.
Yeah, and that is what the Fed themselves have acknowledged. They know that their policy will not affect the supply side, at least that specific supply side that you're describing. But what they've come about is to say we can influence financial conditions, as they say. That's a broad measure of financial variables like the stock market, the housing market, bond market, other related financial markets. And it is working, right? The policy is working through financial markets. There's been a fair bit of negative wealth effect is occurring. Housing market is starting to slow down. That's where mortgage rates are starting to affect, particularly new home buyers, first-time home buyers, as Brainerd mentioned. So there's some tightening of financial conditions in the economy working itself through. And their strategy is to tighten that perhaps even further in order then to have demand moderate such that then the supply side issues that we're dealing with will start to moderate too. Ultimately, supply and demand do get into a new equilibrium. It should be. It's not theoretical. That would be the reality of a policy that they're following. So if you think about the usefulness of rate hikes, you have to think about the demand side of the economy, where it's useful, where it's affecting demand, slowly but surely, but it's happening.
Yep.
To get the supply side in better equilibrium over time. And it's acknowledged by everyone. The report by the United Nations and the World Bank has shown food prices are not going to be alleviated, probably not until late next year or later. That's a huge, distinctively different dynamic than we've had in previous tightening cycles and possible recessions that follow from that. So I do think that we're ending up with employment going slowly higher and inflation staying elevated more too. It will come off, it will move down, but it's not the same as in the past when inflation was really below 2% and unemployment rate would go up, say, to 5-6%. Don't think that dynamic will play out that way. Some people liken it as that's the stagflation scenario, rising unemployment rate with higher inflation. Not exactly the same as the 70s, but the Fed does notice that inflation is at the median of the 1970s. That's what Pollard recently showed. So there's some of that element too, that policy has to work through the demand side to get the supply side in order. And that has somewhat similarity to the 70s dynamic.
Yeah. Yeah. And when Powell was questioned by Congress, he was happy to raise rates, or when he was giving his press conference, similarly, he's happy to raise rates enough, even if it causes a recession, in order to bring down inflation. And some people have compared him to Volcker. And do you think those comparisons are correct? And do you think, and how much hiking do you think the Fed would have to do in order to actually significantly bring down inflation?
Yeah, and I think that he himself admires Volcker, and he has put it in a speech, and the markets picked up on it, that the direction of Volcker is not yet taken, right? They have so far taken just moderate steps. Because Volcker would maybe nowadays, if he was still alive and be the chair of the Fed, he may have hiked by 100 basis points in one meeting. And so, but we're dealing with a different market and different system than back in the 1980s. We're dealing with a significantly more complex system and leverage system, right? So outsized hikes like 100, not so straightforward to do. So that's not the Volcker route, if you will, that Powell may follow. But the idea is that you bring not only the Fed funds rate to, say, the long run rate from the Fed, which is 2.4%, which is considered where inflation is considered to be a target at 2%. It's going to have to get higher than that. Pollard has put that out there and said, like, we probably have to go up to about 3.5% or slightly higher, say sort of 100 basis points difference. That would then be restrictive policy. That is a mini Volcker idea, I think, compared to the 1980s, where you had, let's say, the Fed funds rate was about a good 200 to 300 basis points higher than what the perceived neutral rate was. The yield curve at that time was also inverted by about 100 to 200 basis points. We just had a very mild inversion, just like a month and a half ago or about, right, of literally a few basis points. So there's more room to go here. It's not, I wouldn't say specifically that it is just like Volcker, like literally slamming the brakes and hiking rates, maybe with an intermediate hike. That's unlikely to happen. Mm-hmm. But they are following the monetary theory of monetary policy, like inflation needs to be brought down to get price stability in order to have long-run employment to be stable, right, and the economy to be stable. So they are following that playbook now, and that means that the Fed funds rate will be above the perceived neutral rate, which is estimated 2.5. How far or high? Market seems to be pricing that it could be up to 3.5% by the middle of next year. So that's for now what's out there. How high they will go is to be seen. It depends, again, as I described, how will the next few months, this consistent decline in inflation that Powell, Brainerd, and now Messer have all put out there, how consistent is that decline in inflation? How consistent is the moderation in labor? Again, back to the payroll report today, it's one off from the reports they're looking at. That's not happening yet. So it's to be seen. I think ultimately they will tighten more in restrictive territory, which means higher than neutral.
Mm-hmm. Yeah, that totally makes sense. And one thing that you pointed out earlier today was that when you look at what's going on in the markets, you're seeing higher real yields, even if real yields are negative, and you're also seeing rising dollar. And so you sort of described how historically a higher dollar was usually associated with lower commodity prices. The two tended to trade inversely to each other, but we're not seeing that dynamic play out right now. So why do you think that is, and what do you think are the implications of that?
Yeah, it's an interesting dynamic, because you would think that this dollar having appreciated sort of in, let's say, real effective exchange rate terms, which is like the best way to measure it, it's like the competitive measurement, especially in global terms. Mm-hmm. And having real yields going from -1% to flat, right, to about now actually plus 25 basis points or about on a 10-year real yield, the dollar up about 10-12% in real effective exchange rate terms. That commodity prices have done exactly the opposite. And as I mentioned, it is really for supply specific reasons that has happened. And so the playbook typically was like in a normal sort of, I guess, more equilibrium type market and commodity markets, the rising dollar and the rising rates would have been priced into commodities as a global economic slowdown. And that's not happened. Even with China shutting down its economy temporarily, even then, most of the commodities stayed very elevated, with some decline interim between, but not much more than that. So I think it needs a further rise of US real interest rates and a further appreciation of the US dollar against major currencies, including most emerging markets, to truly impact the commodity market like it used to do. And that, I think, means that, for example, the dollar index, which is a bit heavy skewed on, weighted by the dollar, by the euro, or you take the Bloomberg dollar index with some emerging markets in there, I think both of them would have to be rising by at least another 10, 15% from here in order to get that impact on the commodity market. Again, this is the trajectory of US interest rates. If we do get, say, to a 3.5% nominal rate, inflation does starts to cool off. I think the 10-year real yield will probably reach that 1% positive or a bit higher. And then I do think you have an impact on commodity markets more significantly. But that's, I think, the next 6 months or about, not near term, given the real specific dynamics of supply in energy and agricultural commodities.
Mm-hmm. Yeah. Yeah, no, yeah, that's fair. And what's interesting is that what's interesting is that this inflation has been a lot stickier. And do you think the same is true with wages? Do you think in general, the rise in wages, especially for the lower end of workers, do you think that is going to remain sticky? And do you think the way the labor market has tightened, especially in a supply versus demand dynamic, there's a very high demand for supply, but at the same time, there's a very high demand for labor, but at the same time, the supply of labor seems to be very short. So how sticky is the dynamic that we're observing in the labor market at the moment?
I want to highlight two things there. So it is true that the low skilled workers are getting a lion's share of the nominal wage increase at this moment, because a lot of those jobs are in the leisure services sector, where there's so much demand because of the reopening of the economy. The Atlanta Fed has wage trackers, and they can break it out by low and high skill wages. And there's now a bit of a divergence there. You see low skill wages rising more than high skill wages. So that's good news. Unfortunately, the bad news is that although that is in percentage terms higher for low skill, in nominal terms and actual dollar terms, it's not as much, and certainly doesn't keep up with the pace of inflation. So there is a real income squeeze, if you will, at the lower end of the income distribution. And we would describe that, Medley, as this K-shape idea that was a theme that was highlighted prior to the pandemic. It's sort of, in our view, come a little bit back. Lower incomes are being more squeezed than higher incomes, even though they can participate better and have more demand in the labor market than they ever had before. So that is then, unfortunately, the good news. People are employed, but are at the same time squeeze more. And I think that you will continue to see this until we get a meaningful decline in inflation. However, as we just were talking about it earlier, the old school Phillips curve trade-off idea of between employment and inflation does work that way. If inflation were to come down, or to get it down, the unemployment rate has to go up. And who will be affected mostly? Likely lower skilled workers, right? Who make, who are starting to make more wages, but that will then be there. Unfortunately, the effect there. So that K-shaped idea is setting itself up again.
Yeah.
Post-pandemic, we may enter up in some sort of a form of a K-shaped recovery further from here. And that could be, more income inequality issues again, and social issues. So that comes along with that. It's sort of the aftermath of the pandemic.
Mm-hmm. Yeah, that's fair. Moving on, so I wanted to go across the pond to your home continent, Europe, and what I was interested in is, while in the U.S. things are now rosy and perfect, they're a lot worse in Europe, simply because of the dynamic of how at least the bigger countries in the Eurozone are very dependent on Russian energy. So Germany has come under a lot of criticism for not stepping up against Russia the way a lot of these other countries in the West have. And so how are you thinking about what's going on in Europe? And the second part of my question would be, when it comes to trading the euro, one thing that's interesting is, while a lot of the ECB has done a lot of hawkish talking, they're still doing QE, rates are still negative. We haven't seen much change. So how do you think the ECB hiking cycle plays out?
Yeah, maybe we'll start with that first because they're meeting next week. And the market's been excited and pricing the probability of a 50 basis point hike at the next week meeting, which will be their first hike in more than a decade, right? That they're going to do. Our view is that it will be 25 basis points, but those who are hawkish on the council will put the 50 basis point hike on the table, and likely in September that may be followed by a 50 basis point hike to bring their rates to positive, as they say. So Europe has been in this really difficult economic situation since the financial crisis, where they had the blow from two crises following one another, and then having a really slump aftermath, much more protracted than the US has had. And as a result, they had to resort to negative rates since 2014. Now, the market's almost completely priced out all negative bond yields in the Eurozone. And it's very likely, or I think highly likely, that the ECB will remove negative rates entirely and therefore set itself up for possibly also catching up with the Federal Reserve in the latter half of this year into next year, because their inflation rates, as they came out earlier this week, are accelerating. And that's the other story, of course, at the moment, is that is coming from Ukraine. Only in Europe, it's a very specific situation. It's not just imported inflation from Ukraine in terms of food or related, but it's really the gas market in Europe that's under significant pressure because of their reliance on Russian gas. And this oil embargo that they've put in place, which is sort of phased in now and will really come into effect by the end of the year, is a significant change for European economy, having been so reliant on European oil, Russian oil and Russian gas. And as a result, there's going to be hoarding of gas, potential hoarding, rationing of energy. And that is the risk for the Eurozone economy in particular when that happens, especially in a country like Germany, and that is so industrialized, so dependent upon foreign energy. And there's not enough supply out there really that the US can bring, or from Qatar, or from some other areas, from Norway, or even from my country, Netherlands, next door. There's not enough there to offset entirely what they are losing from importing from Russia, right? So there's this really particular dynamic, and this is why inflation is going to continue to accelerate. I mean, utility bills in Europe are really rising quickly because electricity is all fueled by gas, right? It's all done through natural gas. So that's their issue, and I think as a result that the ECB too has no choice but to eventually, after this first step that they take next week to hike rates and end QE altogether, is to make quicker steps in the future. Just like you're seeing with Canada making that known this week, they want to move faster, and in Asia Pacific you see New Zealand doing that too. They're all the race to the top now instead of race to the bottom, right? That's the new theme here. So the Fed drives it, but the ECB is one of those central banks that has to race to the top. Now they have to make up a lot of room, which means that European interest rates, where bond yield is at 1.3% now, which is the highest since 2017 or about.
Yeah,
that's still considered to be very low, right? The gap between treasuries and bonds is still a good 100 to 150 basis points. So that's likely going to narrow quite a bit, I think, from here, given that the ECB has to move quicker, particularly in the fall. I want to highlight this last one point. There's a convergence of crisis at us, right? And it's particularly in the energy side. And the fall period in particular is where this rationing of energy in Europe could become a risk. The tightness of these markets there, these local gas markets, local electricity markets, is so significant. There's so little available that if there is a cold spell, or even a milder cold spell, it's going to lead to unbelievable gas prices there that we've never seen before. The ECB can do nothing else but raise rates to try to minimize the damage, and that's the situation.
Mm-hmm. Got it. And one thing that we've seen in Europe, and we were discussing a week or so back, was the UK announced the $10,000 fiscal transfers to low-income families, just so that they could just so that they could afford their bills. And obviously, specifically, when the big one is energy, electricity, utilities, and we saw that come along with the 25% tax on ONG companies. And if we saw a similar dynamic in Europe, how reflexive would that would the impact be, in the sense that, say, now that someone's given more money, and therefore now they're able to afford more energy or electricity, and so that drives the price even higher. And now in turn, the government gives you more money, and that works in a self-repeating, self-reinforcing cycle. Is there a possibility of that? And that's usually what's caused. It's usually called demand pull inflation. But how are you thinking through that?
Yeah, UK is a real income squeeze, the most severe in history, and they have no choice but to take measures like that, which likely exacerbate the real income squeeze. Just like our, gas tax subsidies that we're trying to do here actually don't really make a difference for people; only actually makes the problem worse. So the real income squeeze is something that Europe is on the cusp of, if not already experiencing.
Yeah.
And I think that this is a political issue on the one hand, because you're getting those transfers. On the other hand, it's a monetary issue that has to then be met with really blunt action. In the end, what really will happen here is that the UK is an example of a really imbalanced economy with fiscal and trade deficit, and they're dealing with terms of trade shock that could become larger even. And the pound has been on a quite weakening trend. The pound is actually, when it weakens, it transmits inflation faster through imported prices than in the Eurozone. That has to do with UK specific import mechanism and import sensitivity. It imports a lot from Europe, right? So it has that impact is through weaker currencies quicker on domestic inflation. So it's in this sort of a kind of a spiral here, right? So it's a bit of an emerging markets feeding there, right? And the Bank of England has to actually hike much faster to try to control the currency, while you have this on-the-ground income squeeze that's exacerbated by fiscal transfers. So even though that they're trying to offset that, right? So it's not a very easy situation. They're already hitting a recession pretty soon now. If they're not in there already, they have themselves, Bank of England, forecasted that there will be a recession. Very unique. No central bank actually ever does that, but they have basically shown it in their projections that they could hit a recession. So we're in a situation where that's the first part about the European recession story that becomes a bigger story from here, right? If there's one big risk to financial markets in general, is that the Eurozone does slip into a major recession. We will not be insulated from that, US, neither will China, nor Russia, or anywhere else. So it is a big story that's sort of brewing here. And the UK is the first, is that tip of that story. It's where it happens first. So yeah, I think that there's not much that the Bank of England can do other than just to keep following what other central banks are doing, trying to get to the top or over the top, and that's I think where that ultimately leads to a major recession there. That's possible.
Yeah, got it. And going across the going further east is Japan. And so the one thing that a lot of people have joked about or even believe seriously is that Kuroda-san, the governor of the Bank of Japan, he must be very happy about the fact that Japan's finally seeing inflation. But the issue is that the inflation is not what you would consider good inflation, in the sense that it's not driven by growth. It's driven by higher commodity prices, higher import prices, as opposed to something like that would be it's as opposed to something like rise in inflation that's driven by higher GDP growth. And and so how do you think this plays out for Japan? So the Japanese in general have they don't have much labor productivity. They have they have aging demographics, which is again not good. They're also highly reliant on they're highly reliant on importing commodities and then exporting finished goods. And so how do you think this plays out for Japan?
Yeah, if you look at the Japanese yen, that has weakened quite substantially, There's been a lot of chatter about what they're going to do about that. And so far, there's no line drawn in the sand for the yen to weaken, because on the one hand, Japan is the example of deflation for the modern world for the last 25 years. And the mindset in Japan is deflationary. So the Bank of Japan is unwilling to go the direction of the Federal Reserve or the ECB for that matter by lifting the negative rate and ending QE and start reversing that policy, particularly yield curve control policy that they have in place. And so it's a dynamic of where the Bank of Japan remains really easy to support the economy in their view, while they're dealing with also energy terms of trade shock. At the same time, they're reopening Japan now quite rapidly for for tourism and for particularly towards Asia. And then they're having a yen that continues to weaken as the dollar is getting stronger because of Fed policy, as people look at Japan of also an economy that was surprisingly resilient for a period of time, even during COVID, because the way they managed COVID now too is at risk of significant weakening, right? So I think that it will play out that the yen is allowed to weaken further from here, maybe up to 135, maybe as extreme as 140 before real action is taken there.
Yeah.
Before the Bank of Japan policy particularly would actually change as a result, in our view. But then there is also the idea that Japan has now a once in a lifetime opportunity to erase this entire deflation, decades of deflation in one swoop, right? So, and therefore getting the mindset in Japan changed, which is politically important because, they have fought this deflation for many, many years unsuccessfully. It's a psychological issue from their financial crisis in 1989, early 90s, that has just echoed over decades. Right. It is a declining population, right? And as you say, there's very little productivity because of a shrinking population. It is hugely dependent on foreign energy, right? So that is a real concern, right? But yet it's a very technologically advanced economy, a very services-based economy. So it's like the UK to an extent in that way, only with a very different view on inflation. So I think the way it plays out is that as we go through this next stage here and the yen gets likely weaker, that will be just tolerated still. And they will let inflation run till they feel that it is really well at 2.5% or higher. That's what the Bank of Japan put out consistently before they actually start taking action and changing their policy. And if they do that, then that would mean a very different direction potentially in Japan. Right. At the same time, the energy shock is affecting the economy negatively while they're reopening the economy. So it's a similar dynamic as we have here. They will have to deal with high gas prices that are partly offset by the vibrance of the reopening of the economy.
Right, and one thing when it comes to Japan is that it would then be in a similar position as to what Europe is in today, right? So let's say they've experienced a year of higher than they've experienced a year of positive inflation, and now the Bank of Japan decides that they want to hike rates. That would be similar to where the ECB is today, right? Where you're seeing, assuming that commodities still stay high, right around then.
I would say that the Bank of Japan then would reverse course and take out yield curve control and negative rates and essentially moderates its bond buying program. Then the 10-year JGB yield, which is something like 25 basis points or so, would skyrocket, right? It would go really, really quickly to 1.5% in no time, because there's no liquidity in that market. But that's just an effect of catch-up. Now, the good news there is that the Bank of Japan owns 80% of the outstanding, more or less, or up to, combined with all the domestic banks. So it will not lead to a sovereign debt crisis there, something in that nature. It's more like an interest rate and currency adjustment that then has to take place to try to offset the negative effect from inflation. But in their mind, they're not there yet. So as I mentioned, they may be thinking what I'm saying is that there's an opportunity here to try to get rid of deflation thinking as much as possible through this pandemic aftermath. If that's successful, there will be a major currency adjustment and major rates adjustment. Currency a lot stronger, rates higher, and inflation may then go down in Japan. That's maybe a future event, maybe something for next year, not near term though.
Yeah, yeah, yeah. No, that's totally fair. And so when it comes to just thinking through the opportunity set that's available at the moment, how are you thinking through? How are you thinking through one? The sort of obvious trade in long dollar has been buying dollar yen. So when does that move run out? And how are you thinking through that? And broadly speaking, where else do you see opportunities in FX and rates?
Yeah, I'm sort of like getting the playbook learn of trading is sort of form of stagflation that we're dealing with globally, right? We have rising inflation, we have economies that are starting to really slow down, while there's a reopening ongoing, right? And China just coming online now. So, and as I mentioned, Japan and Asia, and even parts of Europe, that's still happening, right? It's unbelievable how that side of the economies are just super strong. So if you think of that macro picture, right, then I think there are three ways to think about it. One, you go with inflation and you go with the idea of where growth is slowing and where it's still advancing. So if you think of it more like in the global term, you would think of that, yeah, in the US it's clear, you want to continue to be underweight growth stocks and overweight more on the cyclical side that particularly takes benefit from reopening. Similarly would be in Europe that way. And to a lesser degree in Asia, the dollar has more room to go, in my view. So it would be a broader appreciation still, which means yen weaker, euro eventually weaker again. All those movements, emerging market currency. So emerging markets in that context are underweight, right? Because dollar, that relationship hasn't changed. As dollar strengthened already, emerging markets have not performed well, aside from all the challenges with Russia and default risk and all those issues. And then think about it too, that you do want to stay invested. I think that being in cash is not maybe the right position. We're not in a calamity. We're not in nuclear warfare yet. Hopefully not. We're not, obviously in the shutdown even from China was significant, but still not so significant as 2020. So I think we do have a pandemic that's really waning, right? So you're not in some sort of a major tail risk in that way. So you should stay invested. You should continue to look at companies that are, positioned with abundant cash, positioned with the ability to buy back that stock and pay dividends. That's, I think, a way to play the cash side of your portfolio. Then lastly, I do think you should stay to an extent offensive, because the reopening is something of not just this year still, but will linger on next year, which means that energy, materials, staples are driving sectors still there, so leadership there, leisure obviously too. The flip side of it is that interest rates have to normalize even further. So rates, global rates, I think they've not topped yet. They will continue to see a further rise from here. As I mentioned, probably another, maybe 0.5% to 1% at least in the United States, if you take that as the benchmark. And eventually, you cannot think, I think, yet of this scenario that people try to trade now. There's a bottom in the market, inflation has peaked, hawkishness has peaked, bearish sentiment is the most bearish ever. This sets the playbook up for a major revival of high multiple or higher multiple growth stocks, and the whole play there. I'm going to buy bonds and buy technology. I think that's a trade in the future, but that's not right now what you want to do. And it turns out to be the case, right? It isn't really working. So I think you should stick with what I described. We're dealing with a stagflationary environment. You go in inflation. What is linked to inflation? Materials, energy, maybe inflation-linked bonds to an extent, right? You think of the reopening. So you're in the more cyclical side of the economy, particularly leisure side or services side. You think of the dollar that will continue to have to strengthen. Therefore, overweight dollar, underweight broadly currencies. Global rates have to continue to normalize. US is taking the lead in that rise.
Right.
And I think that will give you a sort of and then be equal weighted, by the way, because there's one issue with the index at this year. Clearly, finally, those who are quite strong about why being passive in indices are being vindicated. Yes, you're being over concentrated than if you sit in an index. So you got to be more equal weighted between these elements. Invest in companies with sufficient cash that pay dividends, pay the stagflation, be long dollar, underweight rates, and be equal weighted in all those strategies to be better balanced to get through this episode. I think this is a way to play the new stagflationary environment, if you call it that way, as we, does seem that we have a certain 70s idea upon us, right?
Yeah, no, that's very interesting to think about, and when it comes to when you're thinking about when you're thinking about just equities, or just broadly speaking, for example, rates. When you think about the fact that everyone is hiking at the same time. So you're seeing ECB talk about hiking, BOE, BOC, obviously the Fed. How would you think about constructing FX trade in a synchronized hiking cycle versus say something like 2018, where broadly speaking was just the Fed that was hiking?
Yeah, that's an interesting question, because I think if we're all in a race to the top, and the top is not neutral but it's above neutral. For every single central bank, maybe stop at neutral but then go above neutral. It does mean that yield curve should get steeper, not flatter, at least at first. Two, you should be obviously sovereign duration is a treasury duration, that's to be underweight, but linked to that is that corporate bonds, who are very sensitive now to interest rates, continue to underperform as well. There's not much of a scope there just yet, unless you're getting significant wider spreads. It could happen if equities sit down another 10-15% from here, but that's not at this moment. Within it, by the way, again, sectors like energy, like staples, like materials, or even like healthcare, or to an extent utilities, in corporate bonds would do better, maybe somewhat more defensive way. If you pick really high quality companies that have not as much leverage and will have some debt outstanding, but not as much leverage, maybe even buy back that debt, if you will, that you can be positioned that way. Then if you look at emerging markets, some bond markets look interesting now because those central banks are likely or starting to get ahead of their inflation, and that's particularly in Latin America. Chile is a good example of that. Brazil is not exactly there yet, but it's coming. They deal with some political domestic issues, but aside from that, they're getting there. Countries like Colombia, whereas there's other stories like in Asia, for example, where central banks still have to also play catch up as they are opening their economies. Same in some of the African nations, right? So emerging market duration is actually a small subset here. Lastly, if it's again back to currencies, the dollar is obviously the dominant here. Are there other currencies that do well? Well, Brazilian real is continue to perform. That's that carry idea. In some ways, the FX carry does work to an extent, and if you have high enough rates there that show that inflation gets under control, that's something that I think becomes an increasingly important theme in FX, to be positioned against the dollar, even in G10 currencies. Say that the Canadian Central Bank does move faster here and gets that inflation rate better under control, Canadian dollar could actually outperform at some point, right? So, yeah, I think that's the environment.
Yeah, got it. Ben, I want to talk about something completely different. And so, earlier in your career, you mentioned that, you were a PM and SVP at PIMCO, when you worked with Bill Gross. And what was it like working with Bill Gross? And I think I asked that because, Bill Gross is both a phenomenal trader, but at the same time, beyond trading, is a very, he's just a very unique character in the field of finance, to put it that way. So.
Yeah, and I want to speak here just more for myself personally, and not reflect the opinion of others, or reflect the opinion of former employer in any way. But my personal experience, it was fantastic. I mean, it was amazing, because I sat nearby him for many years, and I absorbed his knowledge like a sponge. I listened a lot carefully to what he was saying, how he was outlining his vision, and I gave him a lot of different angles to that vision. So I personally had a very good relationship with him. I also learned quick that he is someone you had to communicate with in a very basic way, in a very like expeditious way, and you're there to really help him, not like trying to do something completely, not say opposing, but say you're trying to help him really out, right? And that's what my role was. I have seen up close him making phenomenal decisions in terms of like fantastic picks in bonds and trades. And he has also made his mistakes. And I think any good PM trader
Right.
has a star trades and has also mistakes. And that's just the nature of their business, of being a PM, right? It's just the risk that you take. From a personality point of view, there's a lot written about him. There's a lot of books out on him. I don't always completely subscribe to all of that. I mean, because my personal experience was actually not negative. I would take an opportunity here to say that once there was an article out about him in Wall Street Journal in February of 2014, that he was described as, someone you can talk to, can look in the eye, and that's not my experience at all. And I could really say that because I sat nearby him. So, that's my own experience, right? I cannot speak for others, but I thought that was incorrect, that was out there from my own perspective of how I experienced that. I've compared it to someone, and if you think about like sitting in a room with Steve Jobs, you deal with a brilliant mind, someone who is 10, 15, 20 steps, maybe 100 steps ahead of you in thinking, and yet thinks in such simplistic terms on the other hand. And I learned from that particularly. Secondly, I learned from him that he was extremely good at filtering information and noise out of the markets. Unbelievable how much information he was getting sent to him by all the portfolio managers at PIMCO that did that daily, but also everybody outside from that, and how he was managing to get really quickly scanning information and knew exactly this is what matters and this is what not matters. That's a real skill to have as a portfolio manager, because there's so much noise out there. And that leads me to also this point of noise. There's this paper by Fisher Black, which is a former Goldman economist, academic.
Yeah,
he wrote this,
Black-Scholes model guy, yeah.
Yeah, he wrote the paper Noise. I recommend you to download from the web and read it. That's actually a framework how Bill would think. There's this idea of there's volatility of price, there's volatility of value, right? There's noise that causes volatility of price, but then you get the value created, right, as a result of volatility. And that volatility you can sell. You can sell volatility of price and create value. That's something very instrumental to his investment framework. He was very big on volatility spikes at time. It's just free money. You can sell it and collect that premium and add yield to your portfolio. It's not risk-free, obviously, but it was always opportunity. And maybe that paradigm is somewhat shifted today, given the circumstances. He is an investor that actually traded the 70s as in stagflation. So he's one of those people that still has that knowledge, that insight that we don't have. But in the era that I worked with him, it was the big bull bond market. That's the bull bond market. Because it was a bond bull market, that's what I say. It's a big bond bull market because, from the financial crisis onward to the time that he left, 10-year US interest rates went from 5.25 down to as low as almost 1.5, 1.3, right? So there's a wave, right? He recognized we were on this long-term wave that one day would shift, would change, and that's what we're in now too. So if I would work with him today, it would be again filtering that noise. What's this shift really going on here? And you would look at it from a cyclical horizon and secular horizon. So I very much appreciated this insight about him looking further out in the future of 5 years and bringing it back to the present of the cyclical horizon. And it would be particularly interesting if both horizons match, right? And they're then it would maybe be a real long-term investment opportunity. But it's an important other pillar of his investment framework. You have to have a secular view and a cyclical view in order to manage a portfolio from the bottom to the top, and vice versa. Maybe as a last point, he was very detailed, obviously oriented, no question, like any manager would be. But I didn't find him so specific that he would give you a really hard time if you didn't know something particularly. In other words, he appreciated honesty, right? He was like, if you don't know, you tell me that's fine too, right? He was not, I think, so difficult that you cannot communicate, work with him because he didn't trust you or didn't believe you. In fact, he very much gave you opportunity. If you come up with a good idea, he'll give you the opportunity to come in to his investment committee meeting and talk about it. I had that opportunity several times. Some of my other colleagues had that too, and that was another thing. I think the best ideas I had at that time, he was amazing to pick out what was your best ideas. I look back at those and say, yeah, those were my best ideas. And that's, I think, his skill and ability, this eagle eye for value of like, he had eagle eyes and figured out that is your best idea. Then come in and talk about it because it's really a unique angle. So it was for me personally a great intellectual, challenging, but great experience. Yeah.
Yeah. Awesome. Ben, on that note, thank you so much for being on the podcast. Before I let you go, could you give the audience a little bit more about where they can find you and your work?
Yeah, so I'm Medley Global Advisors. We work with a company called Energy Aspects. So some of my work is on that website. I'm on Bloomberg and CNBC often, so you can see me there. I do a little bit social media, but not much. LinkedIn is probably the best way to see my my background experience. I think those are the areas to find me.
Yep, awesome, man. Thank you so much for being on the podcast. It was wonderful to have you.
Thank you, Ray. It's great to be here.